Hello, hi, welcome back. So in this video, I'm going to continue what we have covered previously. So we're looking at the effect of maybe 7 transactions on our different types of accounts using the T account as an example. Yeah. So let us go for the first step. That is, we need to understand what are the processes involved. Number one, for every transactions, you need to understand what event has taken place. For example, injection of capital, paying your liability, maybe pay for your expenses or receive money from your customer. So number one, that is number one. Understand the event that has taken place. Number two, we must identify what accounts that are affected. Identify account that are affected, classify whether this account is assets, liability, equity, revenue, expenses, or drawing. And then identify which part of the accounts on the left side, debit, or on the credit side, yeah, the right side, that we should put the figure. So this is the effect, yeah. This is the called as the to debit or to credit, okay. And then we're going to identify whether this account result an increase in assets, increase in liability, or increase in equity. This is where we see the effect on the accounting equations. Okay, so from there we are able to see whether we're going to debit or credit. We're going to debit or credit, and finally we're going to test whether our assets and liability balance is tally or not. Okay, so this is the first example. Rohan Maxon, the owner of the business, invested $200 in the business. I mean, Rohan put his personal money, $2,000, to the business. So, what are the event that is more on, we call it as injection of capital, or Rohan started his business. So, what are the effect? Number one, there will be increase in cash. Business now have cash of $2,000. And the second one, capital. Whose capital? Capital owned by Rohan Maxon. So what are the effect? Cash, for your information, is assets, and capital is equity account. So effect on cash, on asset, as well as effect on owner's equity. So increase in asset, as well as increase in capital. So increase in asset, if you look here, you know that increase in asset, what you should do is you should, increase in assets is debit, whereas increase in capital, you should credit. So this is the effect. If you're looking at the formula or equation that I have showed you earlier, so increase in cash, you're going to debit, whereas increase in capital, you're going to credit. So did R Maxon capital increase or decrease in the transaction? The answer is the capital increase. So you're going to credit your capital. You're going to credit your capital. Okay. What happened to the cash? Did cash increase or decrease in this transaction? The answer is your cash has increased because of this. So cash increase, you're going to debit the amount. You're going to debit the cash account. You're going to debit the cash accounts. Yeah. So that is the first example. So what are the overall effect? We can see from this transaction, we're going to debit our cash by 2,000, and we're going to debit our capital account by the same amount. We're going to credit by the same amount, that is 2,000. So one debit, another one is credit. So this is how the system works. One debit, another one is credit. Second example, Rohan purchased a motor scooter, or we call it as delivery van, for $1,200 for cash. What are the effects of this transaction? There are two effects here. Number one certainly is our cash. There's some effect on our cash. Another one is a motor scooter. We don't have a motor scooter, but now when purchase this equipment, we have a motor scooter. So our cash and delivery equipment. So these are two accounts affected, and both account are fall under assets. Fall under assets. Yeah, cash is asset. Delivery equipment is also an asset. Okay, what are the effect? We have to go back to this rule. Debit for asset, debit increase, credit decrease. Same goes for delivery equipment, debit increase, credit decrease. So the question is whether delivery equipment increase or decrease. The answer is before this you don't have any motor scooter. When we purchase motor scooter, our motor scooter or delivery equipment will increase. The answer is increase. Okay. Second, okay, so what we should do with this, an increase, I'm going to debit. I'm going to debit delivery equipment account. What I mean is I'm going to put 1,200 on the left side. On the left side, this is for increase and asset of asset. How about cash? When we make payment, we made payment of 1,200. Certainly, our cash will reduce. Our cash will reduce. We made the payment 1,200. Our cash will reduce. So reduce in cash is on the credit side. We credit the account 1,200. So this is decrease in cash. Decrease in cash. So overall, we can see that in the second transaction, we're going to debit our delivery equipment, and I'm going to credit my cash account. So debit delivery equipment, credit cash by amount of $1,200. Okay. Next one, example number 3. Purchase a second motor scooter on account for 900. Okay, we need another scooter. So we bought the scooter for 900, but on accounts. On accounts mean on credit. Mean you're not paying for that. You're going to pay later. So it become your liability. So there are two accounts affected. The first one is delivery equipment account. So that is 900. That will be an increase in delivery equipment. Before this, we have a scooter worth 1,200. We purchased the second one 900. So our scooter value or amount will increase from 1,200 to 2,100, increased by $900. And what happened to account payable? Before we don't have any liability. Now we need to pay our supplier. So we call it as account payable. We are going to pay the money maybe in 30 days or in 14 days. So increase, there are two account involved. Delivery equipment is your asset. So it follow the asset rule. Account payable is liability. So what are the effect? If you go back to the previous note, increase in assets, debit, whereas increase in account payable, credit. I repeat, increase in asset, debit, increase in account payable or liability, credit. So what we should do now is we have increase in delivery equipment. So I'm going to debit $900. I'm going to debit $900. I'm going to put on the left side. Whereas for liability, there's increase in liability. So I'm going to credit $900 on our liability account. That is account payable. So this is your liability. Overall, we can see that debit, the asset account, delivery equipment, and credit liability account 900. That is your account payable. So debit and credit must be the same. Credit and debit must be the same. Okay. Let us move to the next example. Example 4, revenue earned in cash. We made deliveries and we receive revenues or income from our services that we have provided our client. So in this case, the deliveries is our revenue. Why? Because our business, Rohan business is to provide delivery services to the client. So we receive $500 in cash. So what are the effect of this transaction? So we have two accounts factored. Number one is revenue accounts. I call it as delivery fees. And the second one is assets, is asset. So revenue is going to increase in revenue and also increase in your cash balance. Okay, I repeat again, your revenue increase, your cash will also increase. So go back to the formula. Any increase in delivery fees, you should credit, whereas any increase in cash, this is asset. Okay, so you should debit your account. So we have this equation. Always remember these equations. And then what are the effect? So I'm going to credit my delivery fees, revenue account. I'm going to increase my cash, that is 500. That means increase in cash, 500. Debit cash, credit delivery fees. Debit cash, credit delivery fees. Okay. So our total debit and credit must be equal. Okay, example number 5. Okay, Rohan made deliveries on account. On account means on credit. You don't get the cash yet. On account means your customer or your client will pay at a later date. So that is $600. So what account are factored? Whether it's going to increase or decrease, and whether you should debit or credit. What happened? Is your revenue increase? Yes, your revenue increase. How about cash? No effect on cash because you don't receive the cash yet. So, but you have another type of account. I call it as account receivable. That is the amount of money you are going to receive from your client. We call it as account receivable. You don't get the money yet, but you're going to receive it soon. So I put it as account receivable. So account receivable is asset. So for asset, an increase in asset should be debited. For revenue, an increase of revenue should be credited. So what's the answer? Account receivable, I'm going to debit by 600, and delivery fees or revenue, I'm going to credit by 600. Okay, we use here account receivable instead of cash because we don't receive the money yet. When we receive the money, I'm going to debit the cash. I'm going to credit the account receivable. I'm going to reduce the account receivable and increase my cash balance. Okay. Okay. Example number 6. We paid Mr. Rohan paid his part-time employee 650 in wages. So when we make the payment, or Mr. Rohan made the payment, his cash will reduce. And this wages is what we call as an expense. Yeah. So increase in an expense, reduce in cash. Okay, increase in an expense, reduce in cash. So an expense increase, so you're going to debit, whereas your cash decrease, you're going to credit. So this is the thing that you should think of. So always remember, increase in expense, debit, reduce in cash or assets, you're going to credit. You're going to credit the accounts. Okay. So our debit 650 and our credit is also 650. So this is the correct transaction. One debit, another one will be credit. Okay. Number 7, the last one. Rohan withdrew 150 in cash for personal use. So the cash balance will reduce and drawing will increase. So we have two types of account involved. Number one is drawing, and the second one is cash. Your cash will reduce, credit. Your drawing will increase. So this is the formula. Increase in drawing, reduce in cash. Increase in drawing, reduce in cash. So the formula is debit, increase in drawing for drawing account, and for cash, credit. Yeah, if there is any a decrease in cash. Okay, so I'm going to debit 150 in your drawing account, and I'm going to credit your cash account by 150. 150. So that is the answer for example 7. Debit, drawing, credit, cash. Debit, drawing, credit, cash. To master this topic, you must remember the accounting equations and what are the rule of increase and decrease. I did provide, maybe there are 10 self-study practices on Moodle, so you can practice and develop your skills and understanding on this topic. Thank you so much for watching this video. Bye-bye.